This is the Nedgroup Investments podcast, where we explore a variety of views and insights that investors care about. Hello, I'm Dumisha Greater from Nedgroup Investments Multi-Management. In this edition of your Market and Economic Wrap, we will recap the Medium-Term Budget Policy Statement, or MTBPS, presented by the Finance Minister yesterday. The fiscal outlook outlined in the MTBPS likely fell short of the market's optimistic expectations. The unexpected downward revisions to revenue estimates highlight that economic activity remains weak and that recovery is still fragile. Ironically, improved operating conditions due to more stable electricity supply negatively impacted tax revenue by reducing demand for alternative solutions, primarily imports, therefore affecting import tax collections. As expected, the National Treasury struggles to contain expenditure growth due to a higher wage bill and increased debt service costs. Consequently, this year's budget deficit will be larger than anticipated, and the pace of fiscal consolidation will be slower than expected. These figures are unlikely to support the bond market or the rand in the coming months. Regarding market reaction, the rand was trading at 17 Rand 63 against the US dollar at the opening of the South African market yesterday morning, strengthening to 17 Rand 53 an hour later. Now, this marked the day's strongest level against the US dollar. At the start of the budget, which was around 2 o'clock, the rand reached a high of 17 Rand 73, and at the close of the South African equity market, the rand was trading at 17 Rand 63. The bond market mirrored the rand's movement, with the yield on the South African 10-year bond yield at 9.4 in the morning, rising to 9.57 during the budget reading. Now, here are some of the takeaways from the MTBPS. From the revenue side, slower revenue growth in the first half of this year will widen the budget deficit to 5% of GDP in the 2024-2025 fiscal year, this from 4.5% that was projected in the February budget. Surprisingly, National Treasury expects lower tax collection for the fiscal year despite increased spending and the boost from the two-part system withdrawals. Now, revenue shortfalls are significant, and this is due to lower personal income tax, value-added tax, and the fuel levy collections, which will outweigh higher corporate tax collections. The anticipated economic recovery is likely to boost revenue growth, which, if combined with expenditure restraint, should help the budget deficit. Now, from the expenditure side, National Treasury remains committed to containing the growth of the public sector wage bill. However, additional funding for the 2023 wage agreement does raise the bill. Our further allocations of 4.4 billion and 6.6 billion will be made in the 2025, 2026 and 2026 and 2027 years respectively. This will be to incentivize early retirement in the civil service as part of the broader measure to contain the wage bill. Now, more details on these measures to contain the wage bill will be announced in the February budget next year. Debt servicing costs are another significant expenditure item. These costs were revised higher by 6.7 billion rand for the 2024-2025 year, amounting to a 32.8 billion rand or 9.2% rise for the fiscal year. This is higher than the National Treasury's 7.3% increase that was projected in February. National Treasury estimates that interest payments are going to exceed the budget of 2024 by 16.6 billion rand. Consequently, the interest payments to revenue ratio is projected to peak at 21.7% in 2025 and 2026, and this averages to about 5.2% of GDP over the medium-term expenditure framework. To put this into perspective, almost 22 Rand of every 100 Rand received in revenue goes towards paying debt, leaving less money available for growth-enhancing projects. Overall, the envisaged fiscal trajectory does face significant risks in the short term. Revenue growth could disappoint if global and local economic growth is weaker than expected. At the same time, expenditure could exceed expectations due to those higher than expected wage costs. Well, we have come to the end of our note. Until next time, do take care from the multi-management team. Nedgroup Collective Investments is an authorized collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za. Nedgroup Investments. See money differently.